With the S&P nearing all-time highs, strong GDP data this week, and sentiment finally shifting around, we have a storm brewing that could be huge for the bulls. Will we push new all-time highs, or are we in store for yet another pullback? With a lot to cover today, let's get right into it. The first thing I want to talk about today is the economic data we have released. As discussed this Monday, GDP was released at 8:30 a.m. this morning. We printed out a 4.3% quarter-over-quarter growth rate versus the 3.3% consensus. That huge beat sent a shockwave of positive sentiment amongst investors and ultimately bolstered S&P near all-time highs. Now we had a core PCE released in line with consensus of 2.9%. With that being said, GDP took the stronger end of influence on the S&P today. So despite core PCE rising back up to 2.9%, it was in line with market consensus, so there was no good or bad shock to influence the market. In addition to that, we see Federal Reserve Governor Christopher Waller believes that inflation will start to fall in the next 3-4 months and rates can come down at a moderate pace, which is a great sign for the bulls, as many are anticipating we see more than one cut in 2026. Now, taking a look at S&P's price action, we can see amongst that GDP print, it bolstered all the way up to the top of our trend channel, as we've been discussing over the past 3 weeks, and ultimately closed above. From here, we want to see a continued push in price to all-time highs and ultimately go on to break our all-time high and hold prices above not only the support line, but our prior all-time high. When looking at RSI, we can see we actually did see a continued break in the trend line we discussed on Monday. And ultimately now we are at the next trend line, which we also want to see break. Should we see RSI break, that could act as a great confirmation in line with our trend channel break that further bullish momentum is ahead. Taking a look at the heat map on FinViz, we can see majority of that strength came from the technology, consumer cyclical, communication services, and financial sectors, with NVIDIA having a large move up of 3%. Given we've had such a rough 2 months for technology, there's no surprise we're seeing some strength return back into the sector. Hopefully with all-time highs potentially breaking, we continue to see that strength in technology to continue to bolster S&P up. So the first stock I want to talk about today is Intuit, a business software company that specializes in financial software. They're best known for products like TurboTax, QuickBooks, Credit Karma, and MailChimp. Recently, Intuit signed a multi-year deal to embed OpenAI models into products, a smart business move in which AI will be able to revolutionize their financial software, allowing them to benefit from the innovation we've been seeing in the AI space. They also announced a multi-year partnership with Circle to integrate stablecoin infrastructure into its platform, aiming to enable faster, lower-cost money movement across TurboTax, QuickBooks, and Credit Karma. They posted strong quarterly results with robust revenue and earnings growth this year, especially from AI-powered tools and QuickBooks adoption. Looking at the most recent quarter, they reported revenue growth of 18% year over year and an EPS of $3.34 a share, beating the expected $3.09 a share from consensus. Their board raised the quarterly dividend 15% to $1.20 a share versus the prior year, showing signs of healthy cash flow management and ability to reward investors. With tax season just around the corner, definitely keep an eye on Intuit, as their story is making for a strong bull case with strong fundamental performance, innovative partnerships advancing the quality of their products, and a captivating trade signal you're about to see next. So here on my screen, I have Intuit's stock price over the past 10 years in the top panel, and in the bottom panel, we have a rolling 90-day percent change. For specifically Intuit, what we see is any time it drops more than 11% over the prior 90 days and crosses back above that threshold, the price rose on average 17.66% over the next 59 trading days. Prior to this trigger we recently saw today, there has been 4 triggers over the past 10 years in which 75% of the time the price was higher, or 3 out of the 4 times. This strategy has performed at a profit factor of roughly 18, meaning that historically speaking, your wins were 18 times larger than your losses on average when looking 59 trading days out from the trigger. Meaning if it were to continue to perform at that profit factor, even if you were only right 5% of the time, you would break even. Taking a closer look at the reactions, on the x-axis we have trading days out from the trigger, 0 being the day the trigger occurred, and 100 being 100 trading days from that trigger. On the y-axis we have a cumulative percent change. So in other words, what you're essentially seeing here is if you were to buy into it on each days of the triggers and hold for 100 consecutive trading days, these will be your returns over time. In blue, we have the average performance across all triggers, in which you can see leading into that 59th day, we roughly get that average return of about 17.66%. Notice that after the 59th day, the average performance begins to lose momentum, in which in historical times we saw some choppiness after this point. Not to say that is guaranteed the 59th day will be the best profit taking time this time around. Just know that historically speaking, that was your best duration to hold when looking at 100 days out from that trigger. Taking a look at the first 20 days, notice that we had very little drawdowns and historical reactions relative to the trigger price, in which the lowest prices we saw in those first 20 days was about down 2%. And when looking at the full 100-day duration, we saw drawdowns upwards of 13% at its worst. Now, this is not to say that this time around it's guaranteed we don't break outside of that range. It's just a helpful reference point to know what was considered normal, at least based off historical reactions. Now, taking a closer look at Intuit's price action, I went ahead and plotted what that 17.66% return would look like, alongside some helpful support and resistance points to pay attention to. So first, if I point your attention to this long position I plotted out, we have that 17.6%, which would bring it to around $792.80 a share. On the downside, I have roughly about 6%, a 3-to-1 risk-reward ratio that many investors like to follow. And a stop loss puts us very close in line with the support zone that we've been developing since the start of 2019. And as you can see over the course of the years, whenever we've gone on to test the support zone, it's marked really good market bottoms in terms of trend reversals. There's only one time where we actually were lower than this trend line, which was COVID. And ultimately, it was very short-lived, roughly about 4 days before we bounced right back above that support zone. As you can see in most recent times, on December 3rd, we had a retest of the support zone and immediately bounced off, which is a great sign of a reversal. Ultimately, this is a great reference point. Should we break down below the support zone, that could be really bearish sign that lower prices are ahead. Now, on the upside, we have a resistance zone that we've been developing since November of 2021. As you can see over the time, whenever we've entered this zone, we very much struggled to break through it. Only recently breaking it since 2021, back in May of 2025. We only spent roughly about 3 months above before breaking and barreling right back below. In recent times, we've been trading within a parallel channel, starting with the high in September of 2025. It looks like we are ultimately going on to attempt to break it finally after about 3 months. Should we continue to see a strong breakthrough, we want to start seeing the price trade above the 200-day MA and ultimately begin to hold the bottom of this resistance zone as support. Should that happen, that brings in our next target, which is the top of the resistance zone, right around $718 a share, and the swing high around $705 or $706 a share. Should we be able to barrel through that, right? That opens the doors of potentially seeing larger returns and closer in line with that average 17.6%, leading us to the target at the top of our resistance zone here from our prior all-time high and all-time high that we realized back in August and July of this year. Second ticker I want to talk about today is MSCI, a leading global provider of investment decision support tools. Best known for its equity and multi-asset class indices, its products are widely licensed by institutional investors and index funds generating recurring fees based on assets under management tied to its benchmarks. MSCI has reported steady organic revenue growth, strong recurring subscription sales, and continued margin expansion across our index and analytics segments. Organic growth has been bolstered by increasing ETF assets tied to its indices and expanding analytical tools. In recent times, MSCI launched an index combining public and private equities, innovating a new way to look at traditional public equities with modeled private equity exposures. This addresses a major gap in traditional benchmarking as the private sector continues to grow extensively. While private market data exists, integrating it seamlessly with public markets into one daily index is a breakthrough that makes private assets more accessible for benchmarking. Innovation like this is what will put MSCI ahead of its competitors. Now, recently we got a trigger for a strategy called Trading Range on December 15th. This strategy works to identify the most extremes of a trading range over a time period and when it's likely to break out to the top of that channel. Now, specifically for MSCI, whenever we've seen a cross above that orange line you can see in the chart, the price rose on average 22.7% over the next 87 trading days. In particular, this specific trigger, we're on day 6 of 87 and currently up 5% from that trigger price on the 15th. Across all 12 realized triggers over the past 10 years, every single time the price was higher. So we have yet to record a loss from this trade signal. Now, taking a closer look at the reactions on the x-axis, again, we have trading days out from the trigger. And on the y-axis, we have cumulative percent change over that time frame. So essentially, if you were to buy MSCI on every single one of the triggers over the past 10 years and hold for 100 trading days, these are what your returns would look like. Now, the average return is highlighted in blue, in which you can see leading up to the 87th day, we reached that 22.7% on average. Also notice in orange is the current trigger. As you can see by the legend, the trigger's on 12/15, and it's currently on the 6th day, up about 5%, performing very closely in line with average. Not to guarantee that it will continue to perform in line with that blue line. However, given history, it gives you a realistic representation of what you could see. In terms of drawdown risk, we saw price drop as much as 14% from the trigger price. Overall, based off historical reactions, they're seeing a much greater potential of upside relative to downside. So taking a look at MSCI's price action here, I went ahead and plotted what that 22.7% average return would look like, bringing us to about $679 a share. And on the downside risk, about 7% or $513.62 a share. On top of this, I also plotted some important support and resistance points to pay attention to. For one being, we've been trading in a triangle since the start of 2022, in which you can see we have a support zone which has yet to break, and a resistance also that has yet to break since that all-time high we realized in November of 2021. In recent times, we've been trading within a parallel channel, in which we can see we have 3 contact points of resistance and roughly 3 contact points of support. Ultimately, the time we did break out of this channel was when we retested the bottom of our triangle. Now, from here, what we want to see is a continued break past the top of this parallel channel to go on to retest the top of our triangle. Should our triangle break, generally triangle breaks are very vigorous and an indication the price is going to continue to go in that direction. That break would open up the doors to potentially seeing that 22.7% return and maybe pushing new all-time highs. As you can see, it's very close in line with that prior all-time high. So the last thing I wanted to talk about was RSI for MSCI. As you can see, we've also been trading within a triangle for RSI, in which you can interpret breaks the same way you can interpret breaks in price action. Should we break above this trend line, there's a great bullish sign that further bullish momentum's ahead. However, bear in mind, we are getting close to reading an overbought signal. So if we do reach the top of this parallel channel, this could suggest that consolidation or a slight pullback would be fairly normal and healthy for a continued uptrend. And so if you are someone who's considering entering MSCI, for example, definitely want to be careful at this point and maybe wait for the break before you anticipate further upside, right? Or wait for a pullback back down to the support channel before we can enter again. So that is all for today. I hope you find the triggers and technicals that I highlighted helpful. If you enjoyed the video, please give it a like and subscribe as I upload regularly. And if you're still watching up to this point, I'd like to say thank you, as it really helps with the algorithm. I'll see you in the next video.